Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Hey mate, welcome back to the show.
Pleasure to be here.
Today we're going to talk about 4 companies and 1 ETF, and we're going to do it a bit more rapid fire than usual. Normally when we go live, we talk for 60 minutes and there's a bit of banter and we have a good day of it. Today, this is a shorter episode and we're going to help our listeners by providing 3 ideas for their watch list, for further research. And I think the companies that we're going to mention speak a lot to kind of who we are as investors. So, but I think maybe the best way to go about it is maybe I go, you go, and then if there's a little bit of question time there, we can have a chat. But before we get to that, I think a really good thing to talk about is maybe the holiday promo that 7 Investing have got going on until the 7th of January. Do you just want to fill us in on that one, mate?
Yeah, mate. So, at 7 Investing, we're looking for people who are long-term investors focused on being long-term investors. So we're giving this a holiday discount if for annual membership. So our annual membership is $399 a year. And that you lock in that price effectively as long as you remain a member. What we're doing for the holiday season as a promo is giving away or taking off $100 if you use the code HOLIDAY. HOLIDAY in capital. I think it's in capital. Then you get $100 off, so your price becomes $299. But it's $299 in perpetuity as long as you remain a member. So it's $100 off every year, as long as, or it could be more than $100 if the price goes up. So that's the promo. If you're interested, go to 7investing.com/subscribe, and you should be able to get it there.
I think a lot of our listeners who aren't members are probably considering it already. So if you are on the fence, you'd be mad not to lock in $100 off into perpetuity. I think that makes a lot of sense. We haven't done anything like this. When I saw it on Twitter, I was thinking to myself, damn, I wish we did that. So maybe I'll have to pick your brain on this in the new year and see how it went. But yeah, that's the holiday code. You can use that at 7investing.com/subscribe. Okay, so let's chat about some companies. The first company that I want to talk about is, I might start with a big one because we'll save the little one for last, which is no surprise to a lot of people, Square /Block Inc. trades on the New York Stock Exchange under the ticker code SQ. So it recently changed its name from Square to Block, and I think this is maybe an afterthought, or maybe it's something from a bit of a move towards this Web3/blockchain, I guess, fascination of the CEO, Jack Dorsey, who is now convinced that Web3 blockchain technologies, public ledgers are the way of the future. And so the company is positioning itself for that future. But at the moment, the real bread and butter of Square is having a point of sale device. You've probably seen it at a local restaurant or cafe where you go up and you tap it. It kind of looks like if you've got AirPods, like I've got in today, that case, it's like a little round white square, and you tap your card or you tap your phone and you pay for your goods. That's the traditional business model of Square. It started with Jack trying to help out a friend. I believe he was a glass blower who had a craft store who was trying to accept payments but couldn't, and missed out on a big deal because he could only accept cash. So he went about designing this thing which plugged into your iPhone and accepted payments on the go. Square makes a clip of the ticket as money comes through the point of sale. The company then expanded through a hackathon into the Cash App, and the Cash App is basically peer-to-peer payments. It's also now basically your on-the-go bank account, and you can access it from your phone. The company shot to prominence in COVID because people were getting their stimulus checks deposited straight into the Cash App, which then enabled them to access money really fast and then start sharing money around, pay for things. The company primarily makes money on that side of the business. I think this is an important point, on money coming into the ecosystem or money going out. It tries to keep that money locked into the ecosystem once it's inside. The final thing that I'll add on Square is that It's currently, and we've talked about this a few times on the show before, you and I, mate, it's currently in the process of taking over Afterpay, which is probably, you could say Affirm and Afterpay are the two world's leading buy now, pay later companies, enabling consumers to split their bill. In Afterpay's case, that's split it over 4 payments. And I think this is a great acquisition for the business because it effectively provides a raw growth engine and customer acquisition from Afterpay with a very sticky ecosystem with the Cash App from Square/Block. And of course, I think Jack is just trying to complete the loop here. He's trying to bring together payments all in one. I mean, that might be a regulatory hurdle in 5 years from now, but for now, it's a really interesting company. Maybe I'll just finally mention one of the risks. I guess the risks here are just kind of execution. This is a very busy space in terms of, PayPal's basically got its super app in Venmo and the PayPal app. Apple Pay's making a move into this space, although it's slightly nuanced in terms of how it does that. We've got, Chinese businesses moving into the space as well. So there's a lot of competition. It's just a really interesting business. Expected to be volatile. That's Square/Block, trades on the New York Stock Exchange under Square. I don't own shares, but I probably will in the near future.
I actually do own shares of Square, and I love this business. Well, the stock is actually down about 40%.
It is.
As I told people, this is a hack. I maintain a spreadsheet of the shares I own, how many I own, what their current market cap is, and how much they're down from their 52-week highs. But I don't have my cost basis on it because the cost basis that you have is immaterial, right? What really matters is going forward. So yeah, I love this business, and you described it fantastic. Actually, one of the things that has happened over time is Square has, Square was typically the SMB. So Square is like, the best way to think of it is like a bit like Tyro, right? A bit like Tyro here in Australia. But it has moved upstream, right? It has got bigger merchants that it's serving. And one of the advantages that we talked about when we talked about their acquisition of Afterpay is that Afterpay actually adds to their enterprise grade customer base, right? When you think of customer, it's not the user, not the consumer, but the enterprise grade retailers and things like that that'll come in. I love this business. I think
that's a good point. And that's actually hidden in the Square 10K. If you're not paying attention, you might not realize that they actually do bespoke stuff as well. So it's not just off the shelf. Here's 1.1%, 1.9% of the processing fee, but sorry, of the purchase price of the goods. But they actually do serve those larger customers, and you can see it in that cohort. It's slowly creeping up. They're getting bigger and bigger in terms of their customer base. So it's really interesting. Good to know you own it. I wish I bought it during COVID.
Well, you can buy it now. It's off 40% from its highs. So yeah, I was looking at it. I haven't actually recently bought any Square shares, but it was on my watch list. It got very close to being a buy, but I had other things that I wanted to buy. So
there's so much.
And I had a decent position in Square. Love it. That's
great, mate.
Is it my
wonderful?
Is it my turn? Is it?
It is your turn. Yes, I'm interested to hear about this business actually.
Okay, so I'm gonna go for a small business called GlobalE. And this is New York's, this is a NASDAQ listed business. GLBE is the code. This is a very interesting business. It's an Israeli business, headquartered in Israel. And it's still founder run. The 3 founders are still involved with the business. What it does, it's a very simple idea. What it does is it says, well, if you're a brand, let's say you're Nike as an example, and you want to sell your goods in every part, different parts of the world. One of the challenges you have is either you can set a Nike shop inside, say, Amazon or eBay, and have a shop there, and then they can manage the logistics for you. But you kind of lose control of your consumers, right? So you don't have a direct to consumer relationship. If you want to have a direct to consumer relationship, you could set up, you can set up the Nike.com.au. You can set up one for Switzerland, one for Iran, one for China, and you can have separate websites and then try to manage all of that. So on the one hand, if you give the responsibility to someone like big intermediary, then you lose the relationship. On the other hand, if you don't do that, then you land up not having direct relationships. And direct relationships with consumers, and this is a theme that I want to talk about, is very important, especially with this change in how privacy works, how tracking works, and how the data sort of about consumers and individuals is now getting very siloed into the internet giants, right? So data in that sense is being controlled effectively by Facebook and Google. But if you want to control the data and experience of your consumers, you want to have the direct consumer relationship. So what this company does is it effectively has a platform and some software that plugs into your one website, but it gives the experience of local usage to consumers. So effectively, if I want to shop, say, assuming using Nike, and I'm say coming from India, it would look like the site is in India. It'll have the experience of being in India. It will probably have local language support. It'll take payments in the local currency, have local shipping. It'll look like local shipping, local return, all of that experience. And that experience is then completely managed by GlobalE. But Nike as a company still has basically a direct to consumer relationship, right? So basically they're providing the software and the backend in terms of shipping to deal with distributing things people want across the globe without really going to a big intermediary like an Amazon or an eBay or things like that.
Can I ask a question?
So
how does this compare to, say, something like Shopify?
it's very similar to actually Shopify's. It's very similar to Shopify's a market product, with the except that it's more bespoke. So the Shopify's market product is focused on smaller merchants and trying to help them ship globally. Actually, anyone, if you set up your own shop, you can ship globally. But the things like you very quickly you'll figure out that if I want to buy a coffee mug from someone, it will turn out that I'd pay probably more in shipping and this and that, and the final pricing is going to look actually very different for the price of the mug because you're using a site, right? And it just, I think the best way to think about it is that this is a bespoke solution for large enterprises with who want to have the direct to consumer relationship. And, so the interesting thing is that Shopify is actually a shareholder in this company. Shopify is actually a major shareholder in this company, and Shopify. So Shopify is competing with this company, and at the same time is also working with this company. And the way I think about it is that the bigger merchants on Shopify, for example, Netflix and a few others, they are using GlobalE's platform. It plugs into Shopify, and the smaller merchants don't need the solution, so they're just on Shopify's global markets platform. So that's the relationship with Shopify, but they also have a relationship with DHL. DHL is a shareholder in this company, and DHL is basically the shipping arm, or one of the major shipping arms for shipping products around the globe for this company. So I think, and the way they make money is they basically make a cut on the gross merchandise volume of the products being sold. And this sort of large brands like the Louis Vuitton group, for example. So you would sell things like Tag Heuer and stuff like that. It's an interesting company, growing really quickly, still very small. It's a sub $10 billion market cap company. I think an interesting idea, worth putting on your watch list. I do want shares.
I've got one more follow-up question. This is a totally new company to me. Does it have any, like in terms of its customers, does it have any concentration risk, like anything meaningful there? Like anyone making up a big slice of that revenue?
Yeah, so I don't remember the numbers off the top of my head, but there is concentration risk. Like, I mean, the top 10 probably accounts for maybe like a good 50% or so of the total revenues that they make. Yeah, so there's concentration risk with this company. It's really small. It's profitable, actually. So it's a profitable on an income basis, an operating basis, and so on. Margins are still low but expanding. The gross margins are low but expanding. So it's an interesting company to watch, and it's an interesting space given sort of the broader theme of just control your, know your customers, have direct relationships with them, and it's expensive to acquire customers again and again through various channels, right? So if you have a customer, you might as well try to retain them and engage with them.
For sure. So that's GlobalE, global-E, GLBE on the NASDAQ. I think that's a really interesting name. I love those. I love it when you come on the show and you talk about like sub 10, sub $20 billion companies, because those are the really interesting ideas, right?
Potential multi-baggers.
Yes, that's it. We talk a lot about Apple and Tesla and Google and all these companies, but it's good to bring in smaller businesses. Okay, speaking of smaller businesses, maybe I'll start with the risk on this one. This company is a very small company, even by Australian standards. It's about $100 million in market cap. So just let that sink in for a moment. The company is, sorry, what that means is if you want to buy shares in this company, just keep in mind that liquidity is a real risk and the company will be volatile. So just, all of those full disclaimers up front. The company is Laserbond and it trades on the ASX under the ticker code LBL. Laserbond is a surface engineering company. So what does that mean? It basically repairs the surface of machinery and equipment to a standard that is better than new. And it does this with, I think it's multiple times less carbon. And so it's more environmentally friendly, but it also repairs it sometimes 10 or 20 times stronger than the original component. So imagine, we're not getting, these microphones or our iPhones fixed. This is a big piece of equipment, such as, the hydraulic on a conveyor belt or on one of those big excavators. And Laserbond will bring that piece of equipment in, repair it to a standard that is better than new, and it's cheaper. It's easier for the customer who might require this piece of equipment to be back to them soon. And it does this through a few different divisions. It's got the products division, which is basically making the products. Then it's got the servicing division, which is basically repairing them and doing all those types of things. So traditional engineering, like if you drive past any industrial state in your area, you would see warehouses that have engineering in there. The difference is, and this is where this third segment of the business comes in and what's most interesting to me, is they have this technology division that basically focuses on licensing. And for the better part of a decade, maybe longer now, the company has had its own R&D department within its manufacturing. So it has scientists and it has its own research leads, and they are actively pursuing the most modern technologies in surface engineering. It seems like one of those tiny, tiny niche little things that really it's not worth the time of some of the other big players. So Laserbond does it. And their technology is so good that they believe that they are the world leaders in many aspects of surface engineering. I'll give you one example, which is chromium. So you might see chrome and chromium on industrial sites. You might see them on hydraulics, those types of things. Chromium is actually very toxic and it can be hazardous to people that are around it. And it can also be hazardous, and it is hazardous to the environment. And so they've come up with cladding technology that basically can produce the same product without using any chromium. And this is a substantial market. And I think, going off the top of my head, when they estimated the TAM, it could be as much as $1 billion, but let's bring it back. Maybe even if it's worth, tens of millions of dollars per year. What Laserbond is seeking to do is take its know-how and its technology and license that technology. So it's licensing it. And I thought at first maybe this is a bit, does this actually happen? Is it just something that's a pie in the sky type thing? Well, in 2021, they've actually signed some of these licensing deals with North American clients, and there seems to be some interest out of Europe as well. And that's a much better model for them to license that technology, because then they don't have to put, boots on the ground in North America or in Europe. They can effectively just become the leader from here in Australia. And they've already signed some of these deals. These are multi-year deals. The business itself is profitable. It's off the top of my head, over the last 5 years, it's compounded its revenue at about 23% per year, but it's done that while paying out 25 to 30% of its profits as dividends, and also reinvesting back into that R&D function. And that chromium technology is actually just one of the cladding technologies that they're pursuing. The other thing is that I'll mention is they are expanding into brownfield assets. So what I mean by that is traditionally they were, Sydney-based. They had these kind of assets all over kind of the eastern seaboard, the lower eastern seaboard, South Australia. They had a presence there. But what they've done more recently is they've identified, well, we should be closer to our mining clients. We should be in Queensland. We should be in Victoria. We should be in Western Australia. And what they've done is they've started to make acquisitions. So they would buy ready-made, this is why I say brownfield, manufacturing facilities or warehouses with people there, with engineers on site, ready to go, with capacity to put through more volume from the products and services division. So the business is profitable, pays a dividend. It's got this kind of, the variant perception, I guess, in this instance is that technology division. It's illiquid, it's small, highly aligned management team with lots of pedigree and a track record. So I like Laserbond. It's on the ASX under ticker code LBL, and full disclosure, I own shares. Oh, I think I've lost you there, mate.
No, I was muted. Sorry.
Oh.
I'm going to have to look into this one. This sounds very interesting to me. Very intriguing.
Yeah, it's an industrial company. So who would have thought that that was exciting? But yeah, it's a like I said, small company, but it's compounding consistently, and it's got a bright future. So a really interesting small business.
Yeah, sometimes the under the radar sort of ones are very interesting to me. Like, this is sort of under the radar, not in a sexy area, as they say. It's not sexy, but sometimes
Yeah.
non-sexy is awesome.
Yeah. Well, I'm glad my pitch aroused your interest, mate, there. You've got the second one for us, which is another US company, which I'm really interested to hear. I think I've seen this one talked about, but I don't know much about it. So you have to fill us in.
Yeah, so this is another boring sort of idea. Probably nice. It's probably
Boring's
more
good.
boring than it's probably less interesting in that sense compared to Laserbond. So this is a company called Taskus. It's an IT outsourcing company. It's founder run. The two founders, actually, it's very rare in the US for founders to own significant chunks of the business, because businesses are typically venture funded, and they get diluted. So if you think founders own less than 10%, that's actually okay. 5% is actually thought of as good. In this case, the founders actually own more than 20% of the business, because Blackstone private equity group had actually taken a majority stake in this business 3-4 years ago. They funded it, and this is a profitable, class leading business in terms of its margins. So operating margin close to 24-25% in IT outsourcing. It's actually very, very good. But the good thing is it has that kind of margin, and it's growing at, I think last quarter was like 60% growth or something like that in revenues. So what is special about this company? They serve basically the tech industry. So they're an IT outsourcer of, I guess, preference of people like, the Coinbase and, Netflix and Facebook. These guys use Taskus. Majority of their employees are based out of Philippines. So it's a US listed company. You can actually think of this as an international company, because, their largest employee base is Philippines, followed by India. Employees of this company love this company. It has very high Glassdoor ratings, really, really high Glassdoor. Again, class leading in that. And I think these guys can continue growing. So there are multiple areas in which they work, things like, they provide. So an example would be, think about social media and content moderation. You need human intervention, and you need some software and human combination to work. So that they would do, whether it's fake news or, is inciting violence and things like that, they would help with that. So that's how they work with, for example, Facebook. If you think about machine learning applications, then labeling of data is a big deal, right? So they work with folks working on self-driving, where you're looking at probably image data and trying to label them, and that labeled data is then fed back to machine learning algorithms. But it might seem like, okay, this is manual, but even labeling data isn't actually an semi-automated process. You have human intervention, but you also need technology to actually label. And labeling data is probably like sort of the most important part, because if you can't label the data properly, then you can't train your models properly. So they do that, and they of course provide contact center style, like customer support and things like that. So even things like know your customers, like if you're Coinbase and people are setting up accounts on Coinbase, which is basically a crypto exchange, or if you're Robinhood and you're setting up an account on Robinhood, which is basically a brokerage, then you need someone to actually help you with the verification of accounts and things like that. So those are the sort of things. Sounds mundane, but mundane stuff is required. I like this for a couple of reasons. I think the valuation is really good. Right now, it's relatively cheap, in my opinion. I do own stock. I've actually bought it a few times recently as well. The other thing I like about it is that it's founder run. They love their employees. They provide great benefits to employees. This is important in this type of industry.
It is.
It has an inflation hedge, which is the other thing I like, which some might sound odd, but most of these companies have a CPI sort of clause in their contracts, right? And this is a great time to sort of go to, say, someone like Facebook and say, well, I need to charge you more. And Facebook is probably going to say yes, because he's going to say, well, I've been paying more to my employees. But then these folks are actually getting the job done in places like India and Philippines and Mexico, where potentially there's a lot of workers who need work, and they probably don't need that, the 10% pay hike to get them to come to work, because there's a lot of people looking for work. So there's that sort of thing that so you get I think the inflation is working for you instead of against you in this case. And I just like the fact that it's small and growing quickly and serving the industry, which is also growing. So digitization is a big trend today, and the digital industry is going to probably outgrow, or outpace other industries. So therefore, these companies have a tailwind. So I like it for a number of reasons. Sometimes, again, boring is really useful. I point to people to a company called EPAM Systems, another IT outsourcing company. What happens with IT outsourcing companies, you start somewhere, and then over time, you sort of
Absolutely.
add on other services, like you could add engineering services, for example. And EPAM System recently got added to the S&P 500. But if you've looked at this company over the last 10 years, this is compounded at something like 40%. So you can have 40% per annum return. It's fabulous. Who would have thought that an IT outsourcing company can do that? So I think you can get, again, really solid market beating returns from someone like Taskus. I do own shares. I like this company lots. And sometimes boring is useful.
I might add just a little bit of personal experience here. I think that kind of thesis, that belief that once you use it, you use a lot more of it. I think that's it's very true, because what tends to happen is the hardest part of establishing an outsourcing relationship is actually establishing a good relationship. So getting in a situation where it works for you. If you're a business looking to scale, like for example, we want to outsource things, right? Just basically data labeling, data input, that sort of stuff. But then you start with that and you establish that relationship and you go from there. You then go, okay, we want more data, we want engineering, we want, all different types of things outsourced. But the hardest part is managing that relationship. So if you can find a trusted partner for that, it becomes just a no-brainer to invest more in that relationship and to spin that up. And I think that's really, really interesting. It's a really interesting company. So that's Task. It's on the NASDAQ under the ticker code TASK. I really, really like it. So Taskus, I wasn't sure when you sent it through if it was Task US, but Taskus is the name. One final.
I'll just add I'll just add I tend to talk up companies I like. So one risk with this company is risk could be it's got Blackstone as a majority owner, right? And Blackstone probably is going to sell. Blackstone probably has like 11 bagger or 12 bagger on their investment in this company. So at some point they have to, and they should potentially be reducing their stake. I don't think that's a bad thing. It's going to add volatility. The other thing I'll point out is, typically the US companies I look at, they would have $500 million plus in, so $500 million is sort of like the minimum sort of, I think I expect these companies to have in cash balance. This company has probably less than $100 million of cash balance. And because the money that they raised during the IPO was effectively used to fund, pay back what they call a phantom share. So people had these phantom shares, the company, employees and founders and other owners had a phantom shares that basically need to be paid. So it doesn't add liquidity to the company. The shares are phantom, so they disappear once they're paid off. So there's no dilution, but there was no cash raised really. So it's a profitable company, but these things have upside leverage and downside leverage as well. Because there's a fixed cost base. So if things go bad, they might have to raise money in a bad situation, which is typically not. So that's the risk, which is probably one of the reasons that this stock sort of has sold off. But again, they're profitable, which is an important point to make.
Yeah, and that's interesting. I think the private equity involvement, you can take that as good or bad too. I guess the other thing is like they IPO it and then they want to get out. So you just got to know who you're buying from at any one time, particularly with smaller companies like this. We see this all over the world. It's not specific to this sector or this market. So, okay, great company. I like it. And it's one for my watch list. I might just end with an ETF for those investors that do prefer that kind of more passive and the kind of, even the semi-active style of investing where you build that core of your portfolio with ETFs and then add some growing companies around the outside. I'm just going to throw one out there, which is one that I don't own yet, but I'm guessing I will probably very soon in 2022, is the BetaShares Diversified High Growth ETF. Trades on the ASX under the ticker code DZZF. So this ETF, just for those of you that don't know, if it says diversified in the name, what that means is it doesn't necessarily invest in shares. It doesn't invest in bonds. It actually invests in other ETFs. So this ETF in particular invests the majority of the money that's inside the ETF into other shares ETFs. So think about it as a basket of baskets. That's how I describe it. And this is kind of like one of those kind of out of the box. I use the analogy if you get HelloFresh or you get some sort of meal delivery service, what you might do is you might say choose the recipes, but it all comes in the box. That's basically an ETF. You know, as individual stock investors, we're picking the ingredients and we're putting it together that box ourselves. But HelloFresh or Marley Spoon or whichever one you go with, the ETF would be the equivalent of that. Now, this is like you get a box, and inside that box, there are multiple boxes for the week. It kind of takes care of your week, and that's what the diversified ETF does. So it's an ETF investing the majority of its money into shares, and then there's a small allocation to bonds in there. But what's important to know is it actually also has an ethical overlay. So it only invests in other ETFs that have ethical overlays. So if that's something that's of interest to you, the DZZF ETF is kind of for higher growth, higher risk investors. It's actually one of those that is really interesting, and it offers the kind of out of the box, ready made, start building your core portfolio from this. So really interesting ETF. There are other diversified ETFs, such as those from Vanguard, but those do not offer the ethical overlay. So that's just one for your watch list in 2022. And mate, I think that's about it for today. We've been through 4 stocks. I went through Laserbond and Square. You went through Taskus and GlobalE. We just had a bit of a snippet there on the end for the BetaShares Diversified High Growth ETF ASX DZZF. We're going to come back and we're going to do a couple more of these shorter episodes in the near future. But just as a reminder for anyone who is playing along at home and is thinking, I want to become a better investor in 2022, you can head to 7investing/subscribe. Use the code HOLIDAY. We're not sure if that's all caps. We should get confirmation on this. You can find us on Twitter at 7A Mahanti and at Owen Rask. And we will put all the links in the show notes for you to take advantage of that offer. In the meantime, find us on Twitter. Give us some recommendations of your own and tell us what you want us to talk about. Mate, it's always a pleasure. Thanks for taking some time to join me on the show today.
Thank you.